if let's say you had invested in SPY at the time, right? If you had just simply bought SPY at the time for $427, and now it's trading at $514, the S&P has returned to you 20, a little over 20% in that time as a buy and hold strategy. Versus if you look at the return on this particular strategy overall, you're looking at just shy of being double that, just shy of 39%. So that's the outperformance that I'm referring to for this strategy. And keep in mind that this is arguably during some of the worst times to be selling selling naked puts, right? Because this is a time when the markets have basically been straight up. Short puts, it's not the best strategy for when markets are roaring higher. But even in that scenario, you are still outperforming the overall market by a pretty significant margin using this type of strategy. However, I do want to explain that the performance of this strategy varies fairly significantly based on when you start trading the strategy. So if you had started trading the strategy 9 months ago, your results wouldn't be as good when the markets were trading sideways into the downside. Or if you started trading the strategy at the beginning of at the end of 2007, right before the financial crisis, you're going to have a much tougher time with this strategy. And that unfortunately really comes down to luck. To some degree, you can also obviously time the markets, and obviously valuations are something to also consider. The fact that markets are so overbought and valuations are fairly stretched. If you were to start the strategy this week, I would say that you might have a challenging couple of months before the strategy does turn profitable for you in the long run. But this is the type of strategy that you do have to remain committed to it in the long run in order to see these types of results. And you could have a few weeks or sometimes even a few months when you do have underperformance. So as I look through 2023, I believe the longest period where we were assigned on the short put and you own the stock and you had to keep selling cover calls in order to get back to break even, the longest streak of cover calls was 16 weeks. So there was a period where nearly 4 months of time, you weren't actually generating income from those short puts. You're basically kind of sitting sideways, generating a little bit of income selling cover calls, really not that much income. So for 4 months out of the year, you kind of didn't have much income to show, but then the other 8 months of the year, you did have a substantial amount of income to show. So that is the nature of this type of strategy. That's the nature of any investor, right? If you were just a buy and hold strategy, you would have the same thing. There would be the same unrealized loss of when the markets are down, you have an unrealized loss, nothing to really show for it. Same thing here. Nothing changes with regard to that. So this strategy doesn't necessarily fix that because it does perform basically on par with the overall markets. When markets do well, this strategy does well. When markets are trading sideways or down, you will slightly outperform the markets in those scenarios as well because you do have some premium coming in from cover calls. But it is important to understand that when markets are down, this is the type of strategy where you're kind of sitting around for sometimes a few weeks, perhaps sometimes a few months. The longest period that I saw in 2013 was about 16 weeks of where you're kind of sitting around as the markets are trading sideways or to the downside. You do need a cash from margin once you do get assigned, right? So that's why I was showing you here to, when you do get assigned, your margin requirement does go up substantially, right? So in this particular case, this required 21,000, 20,000, 23,000. And as these indices continue to rise, your margin requirement is just going to keep rising as well. So when we started the strategy, you needed about $8,700 when SPY was at 427. These days, you need about $10,500. So almost a $2,000 increase per contract in margin requirements just to enter this type of trade. And that does have an influence in terms of your overall return. But it should be normalized because when the value of the stock is higher, you're also technically going to get a higher amount of income for that. And downtrends can result in weeks or months with very little income waiting for the ETF to recover to the original strike. So that's really something to consider when you're thinking about these types of strategies. So While this was a fairly good stretch of time with regards to this overall strategy, it's important to also understand that there are bad times to offset this. So you do have to look at this in the long run in terms of the performance of the strategy. But it is a strategy that when things are somewhat normal, it's a great strategy to kind of trade very passively, and you can do it just week after week without having to do active management on your portfolio.